Welcome back to Good Returns. I'm Matt here with Garrett, working remote this week. I'm coming to you from beautiful central Kentucky. Going to keep it tight, a little quicker. I was right. In fact, we are having a show this week, as Garrett said last week, and lied to everyone about
Yeah.
that. Shame, shame, shame. One of the weeks where the stories are genuinely interesting and worth getting into and getting right. So let's hop into it.
Yeah, I'll wear my shame necklace and hold a cardboard sign on the corner of Broadway next week. Um yeah, so we got in post from inflation, biggest drop in more than 6 years,
What was
broader
that?
market.
What
Say
happened?
it again?
What happened?
Well, we'll talk about it.
We
Inflation inflation biggest monthly drop in 6 years. Broader market is holding steady even as technology stocks have sold off, and Wall Street banks just reported some of the strongest earnings in their history.
Yeah, there's nuance behind all of those headlines and more interesting than the headlines themselves. Quick disclosure before we get into it, everything on Good Returns is for educational purposes only. Nothing we say should be taken as personalized investment advice. Find a trusted advisor if you do not have one. MomentumWealth.us is where you need to go, and we'll be more than happy to help you. But for this show and the content therein, this is really to help you think more clearly about what's going on in the world around you concerning markets, financial planning, and financial advice. So yeah, the S&P essentially flat. Very interesting rotation occurring again. It's the theme we've seen since the beginning of the year. We've had some hiccups, we've had some divergence, but it seems to be constantly coming back to that rotation. Very, very, very interesting things.
Yeah, you also had energy and consumer staples leading. Financials and industrials also participated. We had value stocks, which we've had for the past couple of weeks, kind of outperforming. Equal weight outperformed this week. Weighted index we saw pulled down mainly by the tech names. They
Hmm.
finished negative, which we've talked about before, where you have, the market giveth and the market taketh away, specifically with these high. Would you call it a high beta play? I don't know. It's the high
Well,
the
it's crowded. It's crowded trades, and it doesn't mean that they are inherently bad trades, as we have seen. But when you're looking at it from a risk reward metric, you start seeing the market begin to kind of say, "Hey, well, hold on a second. Hold up, wait a minute. There's something going on here." And we have a handful of these companies that have run up really big. But what about the financials? What about the industrials? What about those areas of the market that are seeing record profits? We saw this in one of our pure momentum driven uh, stock sleeves where, we still, the data was still placing us, heavily in some tech driven names, but we saw rotation begin to happen about 3 weeks ago. Uh, in the momentum sleeves where you're looking at technical data to determine how much you should allocate. And we saw this happening towards industrials and towards financials. Very, very, very interesting things going on. We did have oil, got to say it, apparently every show for the rest of my life. Oil did go up 10%. So we're back near 80. I think we're still at like 79. Bonds, though, were flat. Long dated bonds modestly did underperform, to be expected with that oil in the move. VIX volatility index holding steady. Credit markets remain calm. No alerts being driven there. But let's get into some of the stuff that matters to everyday people, specifically the headlines that the average person is going to see.
Yeah, let's talk about that inflation that you mentioned, or I mentioned, I guess, at the beginning of the show. We had a report come in with this week, and it was kind of encouraging, but there are some caveats that we'll talk about. You had the CPI, Consumer Price Index, fall 0.4% for the month, largest drop in more than 6 years. So that annual inflation rate came down to 3.5 from 4.2% in May. On paper, very good report. But there are some caveats here that we have to be aware of. And the biggest one is that we are looking at backward looking data. Of course, your thesis the whole time has been energy is going to fall and inflation is going to fall along with it. That seems to be the case. Um, we had a 10% decline in gasoline prices during June. And so that's what's reflected kind of in this inflation report. So I think July and August, those are going to be kind of important months. I would say that, there is some definite um, there's some definite desire to get this done on both sides, I think. It keeps going back and forth. Will they, won't they? Iran, are we in a war? Are we not? Yada, 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 so forth and so on. And it keeps muddying everything up. But the thesis, at least, is playing out accurately. It works. Once oil falls, inflation falls with it. So that would lead us to believe, also along with the trades that are happening in financials and industrials and these type of interest rate sensitive environments, those would not be leading if the market took like long term inflation as a serious prospect.
Yeah, and it's simply not. And it really, we've mentioned this before, it really does not matter what happens as it pertains to the Strait of Hormuz. Ultimately, it really does not matter. That is why oil cannot catch a bid to what you think it would. So yes, in the CPI fell precipitously because of the drop in oil. If we're back near a little 80, is that going to increase CPI? Probably not. I remember when all of this happened, oil went up and everybody was on the news saying, oh, well, you're going to have CPI is going to be persistently high because all the oil prices have to filter down into everything else in the economy. Well, 30 days later, the CPI prints lower. But then now people say, well, the CPI is going to go back up. Well, what about the lower oil prices filtering their way through the economy from last month's, cheaper oil contracts? It at the end of the day, each day that goes by, the market is becoming less reactive because the simple math in the oil markets really points to a nothing burger because the problem is going to be solved one way or another. That oil that wants to make its way into your gas tank and into the jet fuel is going to find a way to do it. Um, and again, you can look back at something most people probably have not paid attention to, which is the systematic dismantling of the Russian oil infrastructure by the Ukrainians over the last year. Oil prices did not respond to that in the slightest. And it's not just like we sink a couple of or the Ukrainians, that is, sink a couple of tankers. It is more like they are blowing up facilities that the Russians cannot bring back online. Because of sanctions, they do not have the parts. And even if they did, it may take a year, 2 or 3. So you have this systematic dismantling of one of the largest oil producers on planet Earth. And the oil markets just don't care. They just don't care. Just explain that. Explain that. That's what you have to ask yourself. Self-explain that to me. There's a lot of oil out there that's finding its way where it needs to go. But very interesting, and the dynamics are at play. So it seems to be the common sense reading, just on the surface, oil down, CPI down, everybody stops worrying about rate hikes. But we'll have to see.
That is true. Yeah, that's a good point. The Federal Reserve is going to be looking at this for sure. They will probably see this as a reason to you know, keep the status quo. And Trump was actually asked about that, I think yesterday or the day before, about, would he be happy if the Federal Reserve just kept the rates flat? And he said he trusts Kevin Warsh and he thinks he'd like to see him fall over time, but he's fine with, as long as we don't raise in the intermediate. So I think that's probably, I've said that for a while. I think that's probably what you're going to see happen, unless we have something that's just drastically changes the situation. But as it stands now, that's kind of where we are. Let's talk about, we're going to move kind of quickly through this because we are, in remote locations and we don't want to keep everybody, but let's talk about the kind of rotation that we have been talking about. It's one of the more interesting signals that we've seen in a while. And again, it goes back to this conversation that we had a little while ago about industrials and financials. When we were watching this gold sell off, which we're still kind of watching, it's been selling off for the past couple of weeks, and sector leadership starts to kind of shift along with that. We talked about industrials and financials and small caps actually moving higher while gold did not move higher. And that was a specific pattern and one that tends to show up in environments that markets believe underlying economic conditions are healthy and inflation pressures are temporary rather than structural. And we saw that play out this week. It was very interesting to watch.
Yeah, tech fell 4.3%, but the S&P was flat. Values coming back into play here. Energy and consumer staples got a lift. And financials and industrials participating. So the rotation isn't really new, but it is getting clearer. That's very
Yeah, if we
important to
look at
see.
kind of, yeah, if we kind of look at what that's saying to us at a very high level, Investors appear to be moving money from the most crowded, high expectation trades, these AI trades, the semiconductor trades, and they're moving into parts of the economy and parts of the market that benefit from healthy and growing economy. And financials do well when the economy is expanding and you have credit conditions that are stable. And industrials do well when businesses are building and investing and manufacturing is active. And so the fact that both of these are holding up, and they have been for quite a while now, at least certainly the past few weeks, um, would suggest to us that investors are not necessarily running from risk. They're kind of repositioning within it to a certain extent.
Yeah, and at the same time, you have the S&P within 1% of that early June high, even after weeks of tech volatility. And that does not happen if the market is broadly worried. So it happens when the market's rotating, sorting out winners and losers within a constructive, framework. And it's the AI and the semiconductor trades are moving from pure speculation to like a show me. Okay, you made all this cash. We're thinking all this cash now. Can you keep those rates up? What happens next? And that's a healthy thing to say. That really goes against the narrative of a bubble, because this is not what these types of moves are not really what you see when in a bubble. You see continued mania, but here we are seeing risk management play out in the market as a whole, and the VIX has proven that.
And that's not to say that you can't see an environment where people begin to pile back into that trade once we reach sort of a floor for this pullback. I think that will definitely happen. But it's just interesting anecdotally to see, in the light of the inflation conversation and oil and all that kind of stuff, to see these hallmark signs of sectors and leadership that wouldn't be in leadership if structural inflation was genuinely a concern. So it's just interesting to look at. But yeah, you're right. VIX is in the mid-teens. The credit spreads are tight. These are kind of all the signals that distinguish between a healthy rotation and something more concerning.
Yeah, a
So
broad
right now they're
market.
not saying that there's a breakdown at all.
Broad market participation is resilient. That is what we want to see. We have long said, for at least going back, 5 to 6 years, but right before COVID, that this is the baby boomers specifically it could not be a better time for them to get their retirement plans correct, get their money lined up, get diversified, have a long-term strategic allocation. Yes, you want to participate. When the times are good, you want it. When the times are bad, you want less of that, but a good long-term strategic allocation. And it's because this market has proved to be resilient time and time again, based on numerous things that we won't get into and speculate on now for time's sake. But this is beginning to continue to prove out that thesis. Now let's look at the bank earnings. Very interesting things happen. This will be the last point we hit on before we go a little bit further here. The major Wall Street banks reported their second quarter earnings this week. All right. Results mind blowing. I mean, just mind blowing. Goldman Sachs posted the best quarter in its history. JP Morgan Chase, which is the largest bank, I think, in the world, honestly. I know it is in the US. I think it's the largest bank in the world. Grew earnings by, get this, more than 40% over the last year. That is like software type, big tech type earnings. That's incredible. It's incredible.
Well, it was kind of related to that. I mean, that's why, the same volatility that made the second quarter kind of uncomfortable for most investors is the same reason. You got the Middle East conflict, the oil swings, the AI boom, the pullbacks, the IPOs. All of these things are enormously profitable for banks and financial institutions because they earn fees. When companies raise money like SpaceX, when they do an IPO, banks raise money for that. Investors trade actively. Choppy, kind of busy market is actually good for banks. And it's something we want to see, actually, the financial sector kind of coming back, because it has been dragging for a while.
Yeah, that makes perfect sense. A lot of times when an IPO is done, there's really only two people that get cash most of the time at an IPO, and that's going to be the company going public. They need the cash, so they want to sell you shares for cash, and the banks that charge fees for the distribution of that, which is why not all the time, but a lot of the times we favor being patient and dollar cost averaging in to a new publicly traded stock. We have not even flipped on in any significant way the SpaceX allocation for clients that have requested it. because we're being patient. That's playing out very well. We've already hit the 130s this week, and that's from a high of 220.
125
Yeah,
now.
good.
Yeah.
So yeah, so we've hit. I think I can't remember the exact numbers. I'd have to go back, but in one of the shows, I actually gave some price targets that I'm looking at. One was in the 130s, and then below that, there's another one. So I'd much rather own that, or if you're inclined to own that, if that's something that excites you or something that you'd like to have 3 or 4% of your portfolio in, and it's a conversation we have about risk, then you much rather own that or any other name. It doesn't have to be that, the most popular ones or whatever, but another name, something that you just have conviction about. And as long as it fits within your risk parameters, you'd much rather own that at 120 than at 220, but the banks make money. Also, the debt issuances. We think of Oracle, the largest bond offering at the time that happened at the beginning of the year. SpaceX has also raised capital in the bond markets. So all of those capital raises, the banks generate significant fees on, and that's just being borne out too in these earnings, mind-blowing earnings.
Yeah, it is interesting to watch. And that's not, the practical takeaway there isn't necessarily the way you want to pile into bank stocks. I mean, you might want to look at financial sector. You might want to have a weighting toward, there's regional bank ETFs and that sort of thing. But what we're looking at is the banks are useful for a barometer, really. When they're doing well, it generally reflects a credit environment that's healthy and capital markets still functioning. And so that's not a stress in the financial system necessarily when you see Goldman with their best quarter ever and then JP Morgan up 40%. That's pretty incredible.
It is, and there's some regulatory tailwinds that are beginning and will only get stronger as we go through these next few years that are really helping the banking sector become much more interesting and attractive post
And
2008.
and modern.
Yeah. So there's a lot of very interesting things that we look very much forward to speaking about. Circle is another one. Got a bank charter. Circle is one of the stablecoin issuers. Stablecoin built on the Ethereum network, um, and the amount of money being moved on that in a frictionless manner is shockingly large. And so you're going to see these banks.
Yeah.
J.P. Morgan did 600 million of tokenization in 1 month alone, tokenizing assets generally on the Ethereum blockchain. And that's again, that's their test phase. Their test phase was $600 million in like 3 weeks. Very interesting things occurring. So the banks, I think, not only may we continue to see these above 20% earnings growth, but they may very well begin to get, it's possible, and this is not advice, but it's something interesting to think about. A lot of these large, boring banks may begin to get re-rated more towards tech companies as they begin to not only embrace this new technology, but also be one of the leading forces and the driving forces of adoption for this lower cost, frictionless tokenization of assets that we're seeing. So very interesting things to watch. Definitely not financial advice. Generally, banks are boring businesses, but like you said, it is a barometer. But, we'll wrap here and get to a close before I start sweating profusely. And the the inflation, the inflation fell. We did see that. It's keeping in line. Data that was reversing by the time we read it. Tech sold off, but most of the market held steady. Healthy rotation. We like seeing that. The banks reminded us that a complicated market is not the same as a broken market. And just very interesting. It's a short episode this week. Wish we had more time to unpack a lot of it. It was very interesting occurrences under the headlines to look at.
Yeah, we'll send out the email as always with a little bit of a deeper dive and then some additional points also that we're looking at. With these podcasts, we generally only cover about 3 of those topics that are in that email, but there's usually 5 to 6 topics that are kind of ones we're watching for the week. But yeah, we'll be back here next week, again, remote, I believe. I'll be out next week, but we will be back here talking about all the fun stuff that happened in the markets. Keep an eye out for, crypto especially had a decent week this week, so we'll keep an eye
Yes.
out on that. That's going to go back to the conversation we had about tokenized deposits, and all that kind of works hand in hand.
Yeah.
Maybe we'll talk about tokenized deposits next week. Maybe that's
Yeah.
something interesting to
I
kind
think
of deep
I
dive
think so. I
into.
think it'd be an appropriate time because what we've seen is potentially the reversal of that sell-off in crypto has basically occurred potentially, and what we're seeing is a return to a blockchain narrative, but based upon things that actually matter to your life. to the real world. And that's kind of the Facebook, the Google, the Amazon moment that a lot of people have been waiting for, and we're starting to see the manifestations of that in the early stages. Extremely, extremely exciting things. But
Well, it's
that
kind of
is
similar to what you were. It's kind of similar to what you were talking about with AI, where we're in kind of the show me state. It's kind of the similar
Yeah.
kind of theme with crypto as a whole, too.
Correct.
But,
Yeah.
yeah, we won't belabor the point. Well, that's been good returns for the week. Thanks for spending some time with us this week. Again, we'll be back remote next week. Any questions, any comments, feel free to leave them. If you like this video, be sure to subscribe, share it with somebody you think might find value in it. And as always, have a great weekend, and we will see you guys next week.
Everyone, take care.
Bye-bye.